press the record button here. Hmm. 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 Okay. Let's start our review of the previous week. We will go chronologically through what happened the last week, and slowly dive into what we think is going to happen this week and the upcoming week in the month of September. Not what we think is gonna happen, but how we prepare for what is happening currently. How we prepare for the upcoming September. Let's start it slow, very slow. Start with rate sensitivity and then move towards currencies. These things are interconnected, obviously. Two-year yield. The thing that has been the most important one in understanding the currency market and understanding the equity market and potential impact of rates onto the equity market is the two-year yield. The short end of the curve, and it is in consolidation essentially. We've been calling for consolidation because, why? Because nothing can shift the market's expectation of the Fed policy meaningfully, one or the other direction. Why? Because we don't have on the short-term basis, in the short term, in the even intermediate term for us, meaning the next 3 months, we don't expect a meaningful shift in economic growth data and inflation data. Yes, we think inflation will reaccelerate on the rate of change basis higher, but not enough to significantly shift the market's expectations of Fed policy one or the other way. So, the two-year yield is in consolidation. What happened the last week is, I cannot see because of my stand. JOLTS data pushed us lower, but pushed us lower within the probable boundaries of the range, and we still keep the bullish trend, even though we've broken the trend. This is essentially what happened this day, a couple of weeks prior, when we've broken the trend, even though we remained above the trend level, and then it pushed higher from there. We expect the same thing to happen right here, even though this week, especially this week, because we simply don't have any meaningful economic data that can shift us one way or another, but this is promising, and this should do like this, because if we expect inflation to reaccelerate higher, at least a little bit, at least on the rate of change basis, and settle around 3%, maybe 3.2%, nowhere near close to the 2% inflation target, then this guy is gonna revisit 5.1 again and the previous cycle highs again. This is our expectation, this is our idea and understanding of the short term, which is most likely to be pinned and to continue being pinned. This is positive for the dollar. This is relatively positive for the dollar, but what is very positive for the dollar is what the 10-year and the 30-year is about to do. Okay, I can give you 100 arguments as to why this should drop and as to why we should see 5% on the 10-year. I don't know, we are not the professional macro guys. We just developed a system for us to understand the markets, and from our signal perspective, and not from the signal perspective, but from cross asset class analysis, everything points to repricing higher in 10-year, in 30-year as well. And then we listen to all sides, to every argument there is, and filter them from ourselves and see which is the most probable within the current market regime and what the market is currently pricing. And if you want to pin any story to the why the 10-year yield should go higher from here, let's take the deficits, let's take the term premium, and the term premium right now is negative 60-70 basis points, and if we are getting to the zero term premium, which is reasonable, just because we had a shortage of collateral, and with this new wave of coupons coming onto the market, and will continuing coming onto the market, why term premium shouldn't return back to zero? And if we assume term premium as zero and robust economic growth, at least robust, we don't need crazy reacceleration from here, just a robust economic growth and no recession, and inflation reaccelerating from here. Essentially, we are either in reflation or inflationary regime. Both of them are positive for rates and negative for the bond prices, obviously. And term premium coming out of the market, we should reasonably expect to see 10-year at 4.7, 4.8, 4.9%. And if, God forbid, we will return to the long-term average for the term premium, which is plus 50 basis points, you can see where this might take us. And this is, obviously, this is positive for the dollar and negative for everything else, but this is negative for equities in the case if the rise will be uncontrollably, and this rise will be very fast and vigorous and will be associated with a spike in implied volatility in the MOVE index. Yes, this will deteriorate the collateral pool, and this will cause problems in equity markets. But if the rise will be over time, month over month, week after week, I can see this again, without meaningful spikes in volatility, then equity markets should do well as well. So this is our, but not to get to the equity market just now. This is our understanding of the 10-year. And to get intimate with the signal, I would like to compare this, because this is the same fractal pattern that we've seen in oil just now. And oil, we're gonna go back to let's go there right now. Look at the oil. Oh my god! Just tell me this isn't beautiful. Just tell me this isn't positive for inflation. Yes, it flows in with a lag, but, and I'm just asking you, well, how the hell is China almost dying? If you if you read the Wall Street Journal, they are almost in depression. Europe PMIs is below zero, is below in negative 173 territory. Everywhere is a recession coming, and Europe is already in recession. China is already in recession. What the hell is oil prices doing? Essentially breaking the tail resistance and going higher, significantly higher. I don't know, but this is positive for inflation, and we expect the oil price to reach 93. We've been calling for this, and we've been long oil. We've been accumulating longs throughout the previous 2 weeks, and this paid off nicely so far. So, the fractal pattern is, as you can see right here. In oil, I can see this. I have to shift this somewhere else. This was the tail resistance, one of the most key levels by our understanding. The tail resistance or support. We came into the tail resistance on a big volatility, just on a trading basis, without any meaningful retracements, and without creating a structure or substructure in order to break the tail resistance. We cannot break the tail resistance or support without creating a trending substructure to support this. So essentially, this extended move that we've seen on a daily basis right here, coming into the tail resistance, it was incredibly obvious that we're going to see a reaction from here, and we've gotten this reaction. And this was our call. We've seen this reaction, breaking trade, creation of a higher low on a trending basis, and then continuation higher. And this is what we're essentially seeing right now in 10-year, and let's look at the 30-year. I like this better now. This, we've been calling for repricing rates higher for a long time. We've been accumulating position in this region, in this move. I do remember this vividly. We've been calling for, okay, don't be too happy about this move as of now, because we're gonna get inflation prints, and this will be a very negative inflation print for your rate position, for our rate position, and this is essentially what we received. Didn't change anything at all from the signal perspective. We've just retested the trades. The dollar right there broke the tail resistance just momentarily, and then went back up. We all knew what happened. We all know what happened with the dollar, but at the same time, the rates didn't even shift the trade support. How is that possible? But this is essentially what happened. And on this move lower, we've been calling for, guys, nothing has changed. We've accumulated even more position on the short side in TLT, and this is what we received. This is a meaningful move higher, and as always, as with the oil, when we come into the very important and significant level into the markets, and right now this is the cyclical previous cycle high, very significant level, the very significant point, and we've been pushing into this on a trading basis once again, just like this, on a high volatility. It is inevitable that you get a reaction and a retracement from that level. Always when you push on a high volatility into the key level, you get a retracement, some sort of retracement. Same thing on the downside. You have support level, You come in very fast, you get a rebound. This is what you get. This is what we have gotten. So this is the trend support for the 30-year yield. Now this is the trade support for the 30-year yield, and this is the intermediate lower high which we observe. Very, very reminiscent to what happened in oil. We do not expect these guys to push up higher like oil did, but this is a positive structure, and we do expect the 30-year to never break 401 before we retest 4.7, 4.8. So we've been accumulating, again, we've been accumulating shorts on TLT by selling calls and buying puts. And essentially dollar confirms this, fiat alternatives confirms this, all of the currencies confirm this by the nature of being negative to the dollar. Rates across the complex confirms this, and I don't know. And we have the catalyst. We have the catalyst, which is the CPI print, which is going to be coming on the 13th of September. Let's wait till the catalyst. We acknowledge that this week might not be as impactful, and we just might see another counter trend move. But we're accumulating short TLT in this region, long 30-year in this region, with expectation of repricing higher, and we're building our options position in a way that allows us to be profitable, even if we are essentially, we don't get this type of move. We don't get this type of acceleration higher with implied volatility spiking. And we, frankly, would not expect a meaningful spike in implied volatility. We just expect a repricing higher, a more or less gradual and orderly repricing higher. If this happens, we are perfectly fine with it. So the 30-year higher. The 10-year higher, the same signal right here. 2-year neutral, but with the upward sloping drift, and if we get the inflation that we expect, we're going to get, we might revisit 101, 501, 502 on the 2-year, which is fairly reasonable. These are the rates, and this is why we are still staying bullish on the dollar. We've been calling for this fake move lower. Let me see this one again. Fake this move lower on the dollar, just because of the nature of what the rates did and what everything else except the dollar did. This was an incredibly stinky move by the markets. You always get these types of things. If you don't know what you're doing, if you're looking just at one thing only, this is the benefit at looking at all of the things all at the same time. You can paint a comprehensible picture and see what is out of place. And this move was a very out of place one, an exaggeration by our standards. And this is essentially what we received. We received rates went significantly higher from that point onward, and the dollar came and broken the trend to the positive side. And then, and previous week, when we received the JOLTS data at the beginning of the week, we've received this retracement move right into the trade support. We've taken out the trade support, and this is one of the most bullish signals in our process, in our understanding how the markets move. When you have something moving higher significantly, and instead of breaking the trade or even going lower to the trade, it takes out the trade support. This is the signal. So get ready, we're going to go higher, and we're going to go much higher from here. And this bodes well with our understanding of rates. If rates just stay here and slowly marching higher, this guy is going to revisit 105, 106 as well. This is our understanding. This is not only our understanding. We are long the dollar by the nature of being long the USD/JPY. Yes, holy moly guacamole. Well, if you look at COT data, there isn't much of a short position, not in an incredible short position in USD/JPY, and I believe everybody who's been short has already felt the pain on this move, and this was very funny, to be honest. It was just retested the trend support and continued higher. So the setup on the USD/JPY is as bullish, if we're talking just straight about this chart, as bullish as you can get. I mean, there is nothing more bullish in this market than USD/JPY. I know, there are risks associated with the BOJ movement, but we don't think they're going to happen in September. We do think they might enact another yield curve control change in October, because the inflation will likely to reaccelerate there in Japan in October, which will prompt them to do something. Maybe. But okay, we are managing this position on a day-to-day basis, and well, we can react if something happens. But as of now, we've taken out the tail support and broke into the positive territory, and we essentially taken out the trade support and broken into the positive territory. Dollar is signaling repricing higher, rates in the US, which is signaling repricing higher. The path is open onto the USD/JPY is going to 150 again. I don't think they're going to intervene at the same levels once again, but if we do get a fairly inorderly repricing higher, as we've seen right here, a re-acceleration, a meaningful re-acceleration right here, we are definitely going to be taking partial long positions, partially closing the position, okay? But there's an interesting idea for you. Let me highlight this. Let's compare USD/JPY to the 10-year. USD/JPY, that's the 10-year, perfect. Let's look at the previous interventions, which happened in 22. This is the one that happened, the first one that we received 22nd of September. You see this huge move. In hindsight, didn't even change anything, right? We've still received this massive move higher in the USD/JPY. And on this day, look at this. Look at this massive repricing higher on this day in 10-year. These guys, if we are going to get another, so it's a self-reinforcing cycle. They are selling US Treasuries in order to buy USD/JPY, buy JPY, buy the yen, to strengthen the yen. This prompts more selling in TLT. This prompts long yen to go higher, which puts more pressure on USD/JPY, which puts more. You see that? If they sell, they just might, in the short term, change the direction of the price. In the short term, I mean like this, couple of days. And look at this massive intervention. I don't remember the size, but the size was massive on the first intervention. And then we've received this repricing higher, instantly repricing higher and breakage off this level and pushing higher. And we might get the same doom loop right here. What saved USD/JPY right here is not the intervention. It doesn't have anything to do with the intervention. They might buy yuan in upwards of $30 billion. This just will get you the spike of this magnitude, okay, instead of this magnitude. This will push 10-year even higher, and this will push subsequently JPY even higher because of the yield differential. What will save JPY if they will meaningfully change yield curve control, but they cannot do this. They can do this, but there are two ways of changing yield curve control. Letting it go directly, just completely letting go of yield curve control, which will destroy everything in the markets. It's not going to be funny. Or repatriate all those dollars that they have in foreign currency, in foreign assets, and force them to buy the JGBs. This is one of the ways. This is called financial repression. Force your institutions, pension funds, to buy your debt, and this is one of the possibilities. And they can afford to do this, theoretically. Okay, but this is one of the ways. But if they intervene once again, it's not going to change anything. It's just going to push the 10-year higher, which subsequently will push JPY higher. And once again, what saved the JPY right here? It's not the JPY, not the intervention, but the break in trend support for the dollar itself and for the yields. Why? On the back of lower inflation expectation, not lower inflation expectation, but on the back of the fact that it has become clearly visible, clearly apparent for the markets that inflation has peaked. We've received this 9.1 print, and this was the peak. We have the first print lower, and market expectations significantly lowered, and dollar broke trend, and everything else broke trend. So this what's caused this massive move lower. But right now, look what the rates are once again. If you look at the 10-year, let me see this. This is the last time they intervened. This was, and the rates at that time were at these levels, essentially the same level we are currently. And the JPY is almost at the same levels once again, just a notch lower. We expect this to continue higher to 4.4, 4.5, 4.6 in the upcoming months. This guy is going higher. This guy is going significantly higher. And even if we do get this intervention, this is not going to change anything unless they meaningful change in yield curve control policy. We keeping an eye on this, obviously. But we are definitely revisiting 150 on USD/JPY. This is why we are long this guy. Not only do we have a clear understanding on the macro front, on the fundamental picture, we do have a clear signal and clear entry point currently. We cannot pass on this, so we are long USD/JPY from here. All right. We've gone through oil. Oil is a funny guy, despite recessionary scares. Oil is marching higher. The peak cheap oil is in place. The thing that the government has been highlighted, this underdevelopment, underinvestment in the oil space overall, is causing oil to be relative strength, to regain its relative strength. And this guy is going to 93. And inflation, therefore, is staying around 3.2, 3.3, 3.5, 3.6, God knows where, but not going back down to 2%. Okay, and natural gas, NG1. This deflationary impulse that we received in inflation going back through 9.1 to 3% was on the back of this as well. This is the natural gas, but look at what natural gas is doing. Going nowhere. No positive impulse from the energy component into the inflation rate. Overall, commodities are going higher. This guy is going higher. UUN, beautiful, absolutely beautiful what the UUN is doing, what the whole uranium complex is doing. We're praying for another repricing lower, and we're gonna add more. So we've been highlighting this in every single video. Buy uranium. Not only buy uranium, but where we are buying uranium, so we accumulate position. Our average is 16, somewhere in 16 region. We're quite happy with this position so far. In UUN, not to say the position we have in CCJ. Jesus, give me CCJ, please. In CCJ, and we've been religiously selling puts on this name and holding linear position. Good for us. Good for us. Okay, that bit is clear. We've gone through rates, through the dollar, through euro. Let's not leave euro out, shall we? We do not expect a strengthening in euro. We've broken the trend support first time since, well, long time ago, and we are revisiting 106.63 on euro. This we might see a retracement consolidation this week, but the next week shall bring us lower. This is our position. We don't have position in euro, but it's just to highlight. Rates are, we've talked about rates, but now the gold. Let me say this: if you expect recession, if you expect repricing of rates lower, or at least meaningful repricing in market expectation of rates, be long of gold and silver. Do not accumulate a large position in duration. Duration is not going to work this time if we are going into recession. If any exogenous, endogenous event pushes them to lower rates, this thing is going to absolutely skyrocket gold and silver, especially silver, but not the duration. Duration is a problem of its own making, deficits, and just imagine we're going into recession. What those guys are going to do? What the establishment is going to do? They're going to spend more. They're going to stimulate more. This is, I guess, is set in stone. This is why the duration is not going to do as well as it has done in previous cycles. This is why we're accumulating gold. If you want something, if you want to hedge against recession, gold and silver is the way to do this. And in the face of incredibly rising rates, meaningfully rising rates, gold is doing absolutely fine. Gold is holding up perfectly. Not even just neutral trend. And with this repricing high in rates, we've received just this retest of tail support and continuation. We expect, we've been calling this for a long time, just a negatively sloping consolidation in gold price until we get resolution with rates. So essentially, we do not see gold going meaningfully lower 1805. We don't even see gold going meaningfully lower 1900, to be honest, from this point onwards. But if we do get this opportunity, we will buy more. What can happen for the gold? What has to happen for the gold to retest 1800s? I don't know. Maybe another 2008 scenario, but this time not bank failing, but Apple declaring bankruptcy. I don't know, to be honest. Something has to happen to push dollar higher, inexorably higher, just to create conditions when the correlations turn to 1 and everything is going lower against the dollar. But this will be, as we know, as we've seen in 2020, this will be just an episodic, non-trending spike in dollar higher, which will be subsequently reversed very quickly because of the provision of liquidity into the system, if anything meaningful happens. So this would be a nice buy. We don't expect this to happen. This is inflationary recession. This is a slow-moving type of recession. These things can be marching higher until we get some sort of resolution. Either this move pushes us into the recession, or they enact yield curve control. If we go in 5, 6, 7, just theoretically, let's explore the extremes. 10-year goes 5, 6, 7 over time, and they are doing yield curve control, implicit, not explicit yield curve control. Gold will pick up on this, and this will be positive for the gold price, for the silver price as well. Everything is positive for the gold price, and you have to hold a meaningful allocation to gold price from our perspective and from the perspective of the portfolio approach we adopted from the Chris Cole's Dragon portfolio, and we modified this and made it a dynamic allocation. We can accumulate 20% of long gold position, long fiat alternatives position, not dedicating 20% of our money. And you can do this many different ways, but one of the obvious ones is with options. So be long of gold, undeniably be long of gold. And look at it, just look at this. Look at the rates are. Look where the rates been when look at the gold, where the gold ended up in the cycle, where the rates ended up. Incredible divergence. And look where the gold is right now, very close to the all-time highs, while the rates essentially at the cycle highs right here. Gold is exuding the relative strength and will continue to do so. And silver as well. But once again, we expect continuous repricing of rates higher. It's not the time to expect a repricing of gold higher from here. All right, copper is incredibly connected to the China. We do not expect. Yes, they started toying with some fiscal, the Chinese that is, but nothing meaningful so far. Where is Asia side? Give me Asia side. From the signal perspective, nothing changed. Still bearish trend, bearish trade. Not a long, definitely not a long, not a meaningful long. Do not expect a repricing higher. So far, just because the signal says so, as of now, we might be incorrect right here. But if they continue to do so, continue to re-stimulate, this guy will. We might see 29.30 again on FXI. We don't have a meaningful conviction, strong conviction on the Chinese side, to be honest. But so let's leave it there then. Now, rates in Europe, rates in US. In Europe, rates doing the same thing as they have been doing in US. We are waiting for the break of trade resistance right here in Europe. HYG is just saying that we're not getting a credit event, nothing there, just rising rates weighing heavily on HYG. That's why we are in consolidation here. But if you look at LQDH, the rate hedge corporate bond ETF, bullish trend, bullish trades, no stress whatsoever, no meaningful, no signal to show to us that the danger is near and you shall consider shorting something. No. This is why the US 500 is still a long, and the next stop for the US 500 for the SPY, for the SPX, is again tail resistance 4650, 4700 for SPY. And how we are running this? We are shorting TLT meaningfully. At the same time, we're long SPY. We are long the components. A couple of names that we like the most, that has the most signal strength, has the most thematic underlying themes behind them. The names that we like, essentially. So, yes. And if you're running a portfolio, a couple of things to point out. This is a good regime to run an income generating strategy, such as SVOL, the Simplify Volatility Premium ETF. SVXY is also very good. So on any, if we do get a move, repricing here lower in SPY, which we expect to be a higher low and continue actually higher from here. So things like SVXY, S4, these are generally good things to hold as an income generating part of your portfolio. The whole complex, if we look at the IWM, Diamonds, QQQ, all go through all of these sectors. Most of them are bullish trend, bullish trade, so no signs of weakness, just strength. Even XLY and XLY to XLP, these guys, the ratio of cyclicals to defensives, absolutely signaling a positive repricing high in stocks as well. Ooh, this is an interesting play. Yeah, Nikkei. Beautiful. This is the thing that is bullish trend, bullish tail, bullish trade as well. Just broken into the bullish trend territory back again. This thing is going higher, and this is a beautiful ETF to play this with. It's already exploded higher from here, but if we do get some sort of retracement, how this ETF is built, it meant profit when the USD/JPY is weakening. It gives you allocation to the Nikkei essentially, and if USD/JPY is weakening, then it outperforms the market. If USD/JPY is strengthening, it underperforms the market. And USD/JPY, we expect strength in Nikkei, we expect strength weakening in USD/JPY. This monster will just continue grinding higher, undeniably. So this is a big position for us, and we continue to hold it. Something to point out. Mexico. No, nothing changed here. A couple of names that we like is Amazon and Google. We've sold quite a bit of puts on them, and this is how we do. These are a couple of names that we were short TLT, long couple of names that we like. Google, Amazon is one of them. Are one of them. And that's it. Nothing meaningful to highlight. Keep an eye on LNG, ExxonMobil, Shell, Total. These are the names in the XLE ETF and generally in oil sector, which has the most signal strength, show the most signal strength. So if you want to get long of oil, this is the vehicles you want to do this, and BKR as well. Okay, let's leave it at that. But if you want to go long China, I would strongly consider being long of FCX and SCCO. Essentially, from the rolling correlation, if you study them, you look that there is no difference between FXI, copper. Just let's show this. FXI. Let's open copper. If you just take a look at this, nope. Just to plot it on top of this. Essentially the same chart. Copper moves 1-to-1 to FXI, and therefore the FCX, SCCO, Rio, and all of these copper mining names move in tandem with FXI. If you want to play, this is just one of the interesting ways to play FXI. If you want to play strength in China, you can play this with copper. Okay, I guess this is it. The main things I pointed out, the TLT trade, which is one of the most important trades of the year. We've been calling this, and will likely to continue. USD/JPY, long SPY. From here, we might get a retracement. We acknowledge this, but retracement where? Let's point this out. Where retracement? We not expect SPX. Let's open up SPX. SPX going lower than 45.60, 45.50. Oh, that's it. I hope this was insightful. This definitely was. All right.